Hey guys, Mohsen Ibn here, Certified Financial Planner, and today I thought it would be a good idea to touch on how markets react or how markets behave and answer the question I've been answering for the last 2 days now is what in the world's going on with the stock markets? Why are they crashing, or what's this correction all about? So at the end of the day, the thing that's making it so obvious that things aren't going well in the markets is because everything's happening so fast. You know, the slides, the downward momentum is so strong in the last couple of days, with the exception of today. Well, it's because of the new landscape we're in today. News travels fast with the internet and Twitter and all the content being posted online. Anybody, anywhere in the world can know what's happening in China, in Europe, in US, in Canada, oil prices, interest rates, whatever. So news travel fast, and stocks trading happens online too. So with the click of a button, momentum can change. So that's the number one thing. And obviously media isn't helping. They're adding fuel to the fire by having these crazy headlines, worst single day slide since X and X years and whatever. But as an investor, you got to put that into content and actually think about how much that actually affects you. Certainly the managers over on Bay Street and Wall Street need to know this stuff. They need to be watching the news. I myself need to stay fairly well informed and educated on how all of this works out, only because I have to translate it to my clients and know how to plan my clients' portfolios according to risk tolerance. But these corrections are part of investing. They've been a part of investing for a long time, and anybody who's been invested for a long time knows that markets go up, then they go down suddenly, and then they go up again, and they go down suddenly. But in general terms, you need to remember that they go up more often than they go down. It's just that when they go down, it's so dramatic, right? And it happens fast, and it's kind of scary. It will test people's view of risk and their tolerance of risk. Because people tend to remember maybe the last 3 years of investments. Last 3 years were okay, investment returns were okay, so when all of a sudden it doesn't go okay, people are kind of shaken up, right? So why now? Why are the stock markets correcting or possibly even crashing now? Well, it all has to do with the expected economic growth going forward. It's the same reason oil prices went down, right? If the economic output globally kind of takes a step back, it means the demand for oil is going to go down, which brought oil prices down. Oil prices affected the Canadian economy more than most other economies because we're a big oil exporter, and people working in the oil field affects other areas of our economy. And then due to that, interest rates went down, so then banks and insurance companies were squeezed for profits. So, the TSX has been taking it on the chin, but other markets have been down brutally as well. China, Europe, US, you name it. So the reason it's happening, to put it in a nutshell, is that stock markets coming out of the 07-08 crash kind of took off, and they didn't really look back all that much. They just kind of took off, and they kind of went up for the better part of 5-6 years straight. However, the economy, even though governments kept trying to stimulate and kept interest rates low, the economy never really crawled back to its previous levels. But the stock markets kept going up and up and up. Now, the economy is a huge contributor to stock markets because they're a huge contributor to corporate profits. So if you think the economy is not going to do so well, or it's been going relatively flat, and stock markets are way up here and the economy's kind of stayed down here, there's a gap between stock prices and economic activity. And if the economy is expected to kind of slow down possibly, it means stock prices need to come down in order to reflect that. So that's most likely what's happening, is everybody's come to the conclusion that, economic activity might actually go down or slow down vis-a-vis stay stable or even go up to justify the higher stock prices, and then stocks obviously had to come back. Now, nobody knows whether this is the start of a bigger event or it's a flash in the pan. So as an investor, what you need to do is not panic. Don't go and sell everything. Don't go making any dramatic decisions on your investments, because you know what? Your financial plan or your investment plan likely hasn't changed. If you have 20 years till retirement, you probably still have 20 years to retirement. And the amount of stocks versus bonds versus cash you should own and be invested in probably hasn't changed any either. So as an investor, you have two choices. Either you were prepared knowing that corrections are a part of investing. Hopefully in the last few years you've been setting yourself up for something like this, and if not, you just stay the course. So people that were protected a little bit better by having spread out their money, being very well diversified, are going to fare a little bit better through this. So having a diversified portfolio and having the stomach to see things like this through will determine your success as an investor. So if you have any questions regarding this or anything else, financial planning, please visit marcellebrun.ca. And remember, great advice is just a click away. Cheers, guys.